while we're waiting for people to funnel in, I'll just go ahead and do a brief intro to Bryce Gill. So I've had the pleasure of knowing Bryce for a couple of years now. He's been one of our key partners, along with Ryan Bradley, with one of our portfolio managers at First Trust. I really got close to the First Trust and our team rather during the COVID years because I thought Brian Westbury had some of the best market commentary during those times when there was so much craziness and uncertainty that was going on in the world. And I just thought he had some great perspective, great feedback, and a great way of looking at that time, the world and the changes that were happening and how that related to investment ideas, and putting it in English where people could understand. But nonetheless, Bryce and Ryan have both been really good partners. You can find First Trust funds inside of our money management platform here at the Private Wealth Team. And without further ado, we're really excited to have Bryce on our call. We wanted to open up this call to all clients. I know some we've had in the past that are closed, but we wanted to give everyone the opportunity to sort of listen in to some of the data analysis and just some of the resources that we have, and by extension, our clients have by working through Equitable, our private wealth team, and with First Trust advisors. So without further ado, Bryce, let me introduce Bryce Gill. He's in Austin, and I'll let you take it away, Bryce. Thanks for joining us, and we look forward to hearing your thoughts and perspective.
Well, absolutely. Hey, thanks for having me, Andrew. It's great to be with y'all. Last time me and Andrew were together was down in Corpus Christi. We're at like a conference together, presenting like next to an aircraft carrier. So I guess a little less exciting here over Zoom, but it's great to be with everybody. And obviously, not a shortage of things to talk about with regards to like the markets and the economy. And I guess we have one more day, right? It's only Thursday, but it's been kind of a crazy week in the markets. Things have been bouncing all over the place. Volatility is still a concern. And, for the most part, 2024 has been a really good year. Market's been going up very rapidly. A lot of this, I think, goes back to December of last year. That's when Jerome Powell, he's the current Federal Reserve Chair, he came out and at that point, all we'd heard is, hey, we're going to keep hiking rates. We're going to keep rates higher for longer. We're not going to let the 1970s repeat. We're not going to cut interest rates until we see like the whites of inflation's eyes. Well, pretty much overnight, the Fed completely pivoted and said, hey, mission accomplished on inflation, and, wink, wink, nudge, nudge, we're going to have some rate cuts here on the horizon in 2024. And so, the stock market, generally speaking, it likes profits going up and interest rates going down, right? And so the expectation of cuts from the Federal Reserve, of monetary policy becoming a little bit easier, has really boosted the market, along with, I think a pretty strong economy so far here in 2024. And so that sort of brings us to today, which is, the market's already priced in a lot of rate cuts. I think beginning of this year was probably 4 or 5. Now it's probably 2 or 3, but those have been slowly kind of coming off the table. Uncertainty has once again been rising about whether or not the Fed can actually pull these rate cuts off. And because the market's kind of already priced this in, I think the big question is, hey, can they actually deliver them? Because, if they're not able to, then ultimately, hey, that's probably where we get, some disappointing performance in the equity markets, right? And so the Federal Reserve has what's called a dual mandate. They care about inflation being at 2% or below, and they care about, the economy being strong. And so ultimately, I think to get rate cuts, either the economy has to weaken here, or, inflation has to continue to fall. And so those are the things I'm going to try and focus on, just give you guys the big picture view, kind of what's going on with inflation, the big changes that have kind of happened with the world and the United States in a post-COVID, environment. And then we'll talk a little bit about, hey, maybe, whether or not we'll get some economic weakness here as well. Talk a little bit about the election, maybe how that's going to affect things. And then I think we'll have time for some Q&A at the end. So with that, guys, I'll go ahead and get into it. And Andrew, I don't know if on your end you can give me the ability to share some slides. I might as well pop some of those up for everybody as well.
Sure, I sure will.
Awesome. Thanks, man. All right, perfect. Thank you, sir. Okay. So are these showing up on your end there, Andrew?
They are.
Okay, perfect. So, guys, let's start and just on the good news, I guess, and the reason why I think the Federal Reserve has gotten so much more optimistic, why they sort of changed their tone around inflation and rate cuts. And it would be silly to not start off and talk about all the progress that we have made on inflation, because things have improved significantly in the past year. Inflation's fallen from a peak of around 9% down to 3.5% as of Tuesday, when we got the most recent inflation data. And so there's been a ton of improvement. We're still above the Fed's target, but things have been going the way that they want them to go. And so I think inflation's been overcomplicated the past few years. I think inflation is just too much money chasing too few goods. And when you think about what we did during the pandemic, we printed a whole bunch of money and then we shut down the global production system, right? So all of a sudden there's fewer goods and there's more dollars out there. And my view is, I think a lot of the improvements that we've had in that headline inflation rate, obviously, we've reopened the economy. There aren't just like a rolling series of factory shutdowns all over the world. So things have improved with supply chains. But also, the Fed has really done a pretty good job of dealing with the too much money side of the problem as well. Okay. And the way we like to look at that is something called the M2 money supply. And essentially what this is what we call high powered money in economics. It's dollars in people's hands that they can go out and spend. So think money in people's like checking and savings account. And I've got that M2 line there. That's the blue line. And then I've added a 6% trend line. And all that tries to get at is, hey, basically, if the pandemic hadn't happened, we just kind of grew at the pre-pandemic trend, where would we be at, right? So it gives us a basis of comparison. Early on in COVID, hey, we print $5 trillion. We send checks to basically everybody in the country, stimulus checks, boosted unemployment benefits, PPP loans. The M2 money supply starts growing rapidly, way above trend. The amount of dollars in the U.S. economy expanded by about 40% in just a couple of years, right? So, hey, I like to think of the gap between the blue and the orange line here as basically excess dollars in the U.S. economic system. And so huge gap widens out, right? We just not only have supply chain problems and everything else going on, but we dumped a bunch of gasoline on the fire as well, which is new dollars in the economy as well. So ultimately, the Federal Reserve, they have control over money and interest rates. I think they did a pretty good job of, hey, they raised rates, they tightened monetary policy, they let their balance sheet roll off. And basically what all this means is, hey, the money supply not only stopped growing, but they've actually pulled some of the fuel off the fire. They pulled some of that money out of the system. So you can see the blue line's actually been falling here for the past year or so. And, what this has done, it's shrank the gap between the blue and the orange line. And, we don't have all this excess money anymore. So supply chains have improved, and we've also dealt with some of the too much money side of the problem as well. I think it's a big reason why we've seen such a rapid improvement in the headline inflation rate in the past year or so. Now, that all being said, the Federal Reserve wants to see it at 2%, the inflation rate, and we're at 3.5% right now. And I think getting to 2% is actually going to be the really difficult part, okay? Because some big things have changed with regards to the U.S. economy and really the world economy in the aftermath of COVID-19. And, listen, the last time that we had really high inflation in the United States was, the 70s and the early 80s. Okay. And, a lot of people give credit to Paul Volcker. He was the Federal Reserve chairman under Ronald Reagan and Jimmy Carter back in the day. But he raised interest rates to 20%. Okay. And so Paul Volcker, he gets credit for sort of killing inflation back then. I've always thought that that's kind of the wrong way to look at things. I think, obviously high interest rates can slow down inflation, but the way I think we ultimately fixed inflation back then was globalization. Uh, you know, as soon as Paul Volcker gets out of office, right around 1990, that's when the Soviet Union collapses. 10 years after that, China joins the WTO. They bring 1 billion people in their labor force with them. And so, hey, the economy over here in the West, the Western nations get access to a ton of cheap labor and materials that they can use, right? And labor, at the end of the day, is kind of your biggest expense as a business. And so, hey, if you're able to cut your expenses significantly, maybe you send your production to China, for example. Well, that's going to be really good for your profits. It's also going to be really good for consumer price inflation in the United States because you're just using a bunch of cheap labor to lower the cost of your goods, and you can kind of pass on those cost savings to the end consumer. And there's obviously a trade-off to all of this. And that trade-off was, hey, if you're a domestic worker in the US, you now have to compete with somebody in China making, way less than you. And just as a country in general, well, we deindustrialize. We send all of our supply chains abroad. They get really long and complex. Now, this works relatively well as long as the world's peaceful. Nothing's interfering with global trade and the free flow and movement of goods and services. But obviously, COVID-19 threw a huge wrench in the gears. All of a sudden, factories all over the world are just semi-randomly shutting down, and there's just no way to really keep up with all of this. And so supply chains start to break apart. We have shortages of critical goods, sort of you name it. And the aftermath of all that, obviously, hey, it's China could invade Taiwan, Russia invaded Ukraine, Israel's at war in Palestine. Everybody's worried about Israel and Iran. So just like the list of geopolitical risks is going up and up and up. And so the result of all this has been the United States has begun to bring back production to our shores in a way that hasn't happened in a really long time. Okay, so what I've done here on this chart, I've just graphed out construction spending on manufacturing facilities. So this is all data from the US Census Bureau. You could look up how many like amusement parks we're building if you wanted to, right? This is just manufacturing construction. And so what you see is, hey, we get out of the COVID pandemic, 2022, we're reopening everything, vaccines are out. We pass these big, industrial policy legislation bills, the CHIPS Act, the Inflation Reduction Act. Well, hey, all of a sudden, spending on factory construction doubles in basically a year. It's, still going vertical today. And so ultimately, hey, we're building a ton of factories in the United States. We're trying to bring supply chains home, especially for things like semiconductors and green energy and pharmaceuticals, things that are, more strategic in nature, right? Because we're worried about other countries using those supply chains against us. So I think all that stuff's really positive. And ultimately what it's done is, I think, boosted employee negotiating power in the United States for the first time in a really long time. And so, an example I'll give is how much more expensive my Chipotle has gotten, right? I mean, I used to go to Chipotle, it was like $12 for a burrito. Now it's like $25 to go to Chipotle. And, I get guacamole, sure, but I feel like I deserve the guacamole. I don't know. But big picture, it's just that labor's gotten way more expensive. And most of the labor cost increases are happening at the lower end of the income spectrum. And so those people tend to go out and, spend all the money that they get as a raise. Whereas, hey, a CEO gets more pay, they end up saving a lot of it, right? So I think what's happened is this stronger labor market, these faster wage gains have fed right back into the inflation rate. Some people on this call, you might have heard of like a wage price spiral in the 1970s. This just described the fact that, hey, there's a ton of people with union contracts. So if inflation went up 10% in a year, their pay went up 10% in a year. And then they just go out and spend that money again, and it would recycle right back into the economy and boost inflation. I think we're having sort of a similar thing here where the reshoring of production, the higher demand for US labor has, caused wage gains to go up. and especially in places where people are going to spend all those wage gains almost immediately on consumer goods and services. And so it's boosted, inflation from a baseline of, probably a little bit below 2% pre-pandemic to probably around 3% today. And this is what we call like sticky inflation. And the reason why is, you raise someone's pay, you can't really cut it. Whereas, let's say like energy prices go way up, oil prices go way up in 1 year. Well, they can fall right back down again the next year, right? So, hey, all this means that inflation is probably stickier than the Fed wants it to be. I think a lot of this means that, the inflation situation is frankly outside of the Fed's control at this point. A lot of it just has to do with, the massive amount of investment and reshoring of production that's happening for the United States. And so, this is all really good for the economy. It's kept the unemployment rate low. It's kept investment high, capital expenditures high for businesses. The labor market is very strong still. However, as investors, if we're, and by the way, all those things are good for like profits, but as investors, if we're waiting for the Fed to cut rates by getting inflation at 2%, I think they're going to be hard pressed to do that here in 2024. Ultimately, we'll be able to get inflation back down. It'll be automation, it'll be AI, it'll be whatever else that sort of boosts, people's productivity, but that takes longer than 12 months to happen. And so, hey, the Federal Reserve, I think, is having a lot of trouble getting to 2%. And I think it's going to make it so, hey, they're not going to be able to cut rates in 2024 just based on the inflation situation alone. And that means that ultimately, they're going to need some kind of economic weakness to maybe justify rate cuts. And today, we don't have a ton of evidence of that economic weakness yet. And we're getting closer and closer to election season. So, let me say, that just because it is an election year, all right, and it's, by the way, one of the weirdest election years to forecast or talk about as an economist because, we sort of know it's going to be Joe Biden and Donald Trump, but I don't think any of that's been like officially declared yet. We don't really have any official party platforms to look at. Like I can't go look at all their economic proposals and sort of like price them out or make estimates about what they do to the economy. And so that kind of makes things difficult here. But from the Fed's perspective, people always ask, hey, it's an election year. Is the Fed's decision making politicized? Are they going to step in to help one candidate or the other with maybe some rate cuts to boost the economy? And I don't think it's about one candidate versus the other with the Federal Reserve. I think it's just about the federal budget. We have $33 trillion in debt. If interest rates are very low, that's not so much a problem, but interest rates around 5% makes that a difficult situation. And so I personally believe the Fed is looking for, basically an excuse to step in and help the federal budget. Okay. So if I was going to guess where maybe some economic weakness or, potentially an excuse for the Federal Reserve to cut rates would come from, I think it would be some headwinds to consumer spending. Now, I don't think we're going to have a massive recession. I don't think the unemployment rate's going to go way up. Generally speaking, I think, once again, the U.S. economy is pretty healthy because we're bringing all this production back home. We're investing a ton domestically. We need all these people, to work domestically that we used to just hire like foreign labor to do, all these tasks, right? Manufacturing and building and everything else. But I do think monetary policy, I do think the increase in interest rates in the past year and a half is actually creating some headwinds to, consumer spending continue to go up and up and up. And so one thing I think has kept consumer spending so strong in the US over the past few years has been what we call excess savings. Basically, during the pandemic, people got free money from the government. They, weren't able to go on vacation or go on a cruise or go to a restaurant or a bar. So their savings rate went really high. They squirreled a bunch of that money away. And then lastly, hey, their interest payments fell. Everybody refinanced their mortgage at a lower interest rate. Student loans were paused, everything else. So the combination of all these things created a lot of excess savings. we estimate around $2 trillion in excess savings as we reopen the economy. As of the end of last year, those excess savings were down by 90%. They were mostly gone. So if I just project that trend forward, it seems like today those excess savings are probably, behind us, right? People have already used most of those at this point. So I don't think those can really goose economic activity much anymore. You add on top of that the increase in personal interest payments. So that's what I have a chart here of. This is just payments of interest made by individuals. And the reason we like to look at this is that monetary policy, the Fed raising or lowering interest rates, the way that speeds up or slows down the economy is that people have higher or lower interest payments. And, if you spend $500 more a month on interest, you obviously have $500 less to spend on some other discretionary spending, right? So it sort of like creates or destroys demand in the economy. I've also added a trend line here that just shows us, hey, basically, where would we be if the pandemic hadn't happened? And so, early on, you see how much personal interest payments fall. They stay well below that line for, 2.5 years. And, then the Fed starts hiking rates really rapidly, right? And so personal interest payments in the United States have risen from around $250 billion in the past year to, nearly $600 billion. That's a change of, $350 billion that's no longer available to spend on other discretionary purchases. And so I just think that's a big headwind for consumer spending to grow over and above where it's already at today, right? Don't think there's going to be a massive drop off. $350 billion is, by the way, what you'd expect overall personal income in the U.S. to expand by just, organic job gains and wage gains in a year. So, I just think higher interest costs are eating people's ability to go out and spend more than they did last year. That's sort of my argument. And ultimately, if this shows up as, weak retail sales or, weak economic data in general, that ultimately could be the catalyst for the Fed to step in and cut rates and quote unquote support the economy. And obviously, I think the markets would really like that. I think right now we have a ton of rate cuts. Well, I guess not a ton anymore. 2 to 3 rate cuts priced in. That's what the Federal Reserve said they're still expecting to do. It's just right now their dual mandate is not really giving them an excuse to do them, right? Inflation's still too high and the economy is still too strong. I think inflation is going to remain high. I think there's all these changes around globalization and, the cheap labor is drying up, demographics are peaking, and we're reshoring all this production. So I think, maybe some headwinds to consumer spending are sort of the best bet that we have as investors to get the rate cuts that, the market is widely expecting and is probably already priced in. So with that, I think I'm right around 25 minutes. I want to make sure I respect everybody's time. Thank you guys so much for joining us. And yeah, if we have any questions, I'm happy to hang out and answer some of those.
Hey, Bryce, I really appreciate that. Was some awesome perspective and awesome data. And I think the consensus is that we all deserve guacamole. And
I agree. Absolutely.
So we did get some questions beforehand, and we really have time, unfortunately, for one, but I think it's a big one. And and I think it's timely given the inflation data that came out yesterday and the March CPI numbers. For those on the call, CPI is how the Feds measure the inflationary data, and it came out a little higher than expected. Can you speak to what that data may mean, what we may see, how markets may react to that, certain trends when we're really evaluating and how to navigate through not just economic conditions, but as we get into election season in the fall?
Yeah, absolutely. So, election season, right? You're going to see Republicans and Democrats both come out and try to spin all of this in the most political way possible for their own benefit. What I would say about the inflation data is, hey, essentially the past 3-4 months have been going the direct opposite of the way the Federal Reserve wants them to go. The reality is inflation has not fallen whatsoever since the summer of last year. So we're getting on close to a year with basically no improvements in inflation whatsoever. A lot of the heavy lifting on inflation falling, I mentioned like the too much money side of things being improved upon. A lot of it too is just like energy prices were falling in the aftermath of the Ukraine-Russia invasion, right? So we've had the same thing happen, reverse now. Oil prices have been climbing. That's been hurting the inflation picture. And so I think a lot of people are now accepting, hey, there's sticky inflation in here in the system. 2% is going to be very difficult to get to. And I think as the market sort of accepts that this immaculate disinflation or this downward trend has kind of been broken, you're going to see a lot more volatility, right? Where we just dissect every single report, and the market sort of bounces around because it's trying to figure out whether or not the data supports the Fed cutting or not. And I think that CPI report yesterday very clearly did not support the Fed cutting interest rates. It went the opposite direction.
Very good. Well, as always, we appreciate your insight. We appreciate the partnership with First Trust. And for the clients and attendees on the call, we appreciate each and one of you. I do want to pass it over to Oliver Ochoa for a few of the comments in terms of translating this data into some of the things that we're rebalancing within current portfolios. Some we've already started, some will continue to make drifts, but kind of a next couple minutes just on what this means and how we're going to interpret this data and apply it to maintain the integrities of our private wealth portfolios. Aldo?
Yeah, thank you, Andrew. So a couple of things that you'll touch on after I share some items here for us is talking about the private wealth portfolio we started a couple of years ago with certain clientele. So it's important for clients to check the box that we're maintaining objectivity as a firm. We're fiduciaries to our clients, so that's super important. That was a trendy word that was being used, thrown around out there 3-4 years ago. So it's important for you to make sure that we check that box. At the end of the day, when we look at our portfolios, costs matter, right? That's something that we definitely pay attention to. It's not necessarily what the portfolio makes, it's really what we get to keep inside the portfolio. There's always a conversation about passive versus active investing. We always lean towards passive strategies for our long-term investors, right? So that's one of our core convictions. One of the ones that we really believe in our portfolios is we believe in America, large U.S. company conviction in our portfolios. You'll sometimes see by the clear overweight that we have in large companies, U.S. companies. So that's reinforced again, domestic over international, right? The U.S. has played a significant role in global innovation, competition, monetary policy, and we expect it to continue to do so. One of the things that we also understand, right, when we invest in the market, we understand that it goes up and down. Part of really having a solid strategies is patience, right, and not make rash decisions, especially when we have years like we have in 2024, where we have elections, right, a lot of uncertainties, the same thing that happened, similar fluctuations that we saw that caused a lot of this uncertainty again in 2022 with international and national activities economically. The next thing is markets are efficient, right? So markets are priced out. And a long-term investment, it's important to keep a strategy and keep our path, not to deviate from that, as we strongly believe that the markets are efficient and we buy fundamentals, not trends. Trends is a very popular thing right now because it's being pushed by the media, right? So when we do our investing, especially in our private wealth portfolios and for long-term investments, we really hold that to our portfolios. And then for some of our clients, we really focus on tax efficient strategies, right? So we can dive in more about that, or you can connect with your individual advisor. Piggybacking on a lot of the things that Andrew mentioned and Bryce mentioned, 2023, it was a great year for the equity market, right? So we saw a decent double-digit increase in the S&P 500, mainly led by the Magnificent Seven, right? The main companies that took a major beat down in 2022, a good concentration of those came back roaring in 2023. That being said, you will see in the rebalancing quarterly, semi-annually, depending on your portfolio, that we'll be starting mitigating some of that risk by putting some buffers around our large cap strategies as it relates to the portfolios to slowly protect some of the gains that we had in 2022. On the fixed income side of things, we are looking for to extend duration on interest. So locking in some of the rates for the longer duration while they're high, right? We keep an eye on inflation. We'll keep an eye on what the Fed is doing from an interest rate perspective. So that's kind of a summary, right, on two items. One is the convictions that the private wealth group and the portfolios, that's how we evaluate them. And then a couple comments there towards what we saw in 2022 and what we're doing inside the portfolios to capture some of those gains. I know, Andrew, you wanted to touch on the private wealth portfolio, the success we had with that, and then some of those items.
Yeah, thanks, Aldo. So for those that are on the call, we've really, been transitioned and learning different sort of cycles as they, the aggressive increases of fiscal and monetary policy that we saw, and really trying to get more up to date with today's economic conditions of how quick rates were on the rise. So I think there's a couple to add, just if I could give you some thoughts. Number one, we're not necessarily looking for the needle in the haystack. We're just buying the haystack. We do, as Aldo said, have a very large U.S. company conviction. We think it's better to buy a wonderful company at a fair price than a fair company at a wonderful price. It's never paid to bet against America. Americans are resilient and they come through things. So, and as anyone on the call can tell you, and you as investors yourself, what have we learned about markets over the last 20 to 30 years? Well, we've learned markets go up and they go down. We've learned that market volatility is the price that we pay to grow wealth. Time is our friend, impulse is our enemy. And there's no better teacher than history that'll help us to determine the future. We're also facing, I think, rising tax environments. So I'm glad Aldo mentioned that because ultimately there's nothing wrong with paying taxes, but we want to just make sure that our clients don't tip them. So with that said, I'll close out the call here, and I want to say thank you to all of our clients, all of our referral partners, any introductions that we've had. We reorganized our team in 2018 alongside the reorganize of Equitable as we transitioned away from AXA Group. And this team also came together. You'll see several faces, some old, some new on this call. And we've really been able to grow and I'm very proud to say since 2018, we've put almost $600 million on our platform. I don't say that to brag. I say that to rather as a thank you. Our clients, our trusted partners, you guys really are the best, which in turn allow us to be. And so we're excited to continue this journey with you, alongside you, and to bring you the best advice that our team possibly can. So for those that are currently on our private wealth platform, in our investment advisory clients, here's the takeaway. The good news is these steps, these rebalances is already implemented in your portfolios. We're already making shifts toward protecting, hedging, and diversifying to, as we get into elections, nothing wrong with taking chips off the table, especially the gains that we saw last year. Not trying to time the market at all, but rather trying to manage the volatility that we think we'll see toward the end of the year. The second point, this is an ask, that we would ask you for feedback. We are really trying to find the best way that people want information and how we can deliver that and increase our communication and transparency with our clients. And so if you, those that are on this call, if you have a minute, the ask would be to drop your advisor or your key service relationship manager, drop them a line from this call. And we want to know the good, the bad, the different. What can we do better? What is the content that you want to see? What is relevant as we craft out our messaging throughout the end of the year? And so we always want to take feedback constructively so that we can make this time together as most valuable for you. With that, if you have friends, family, if there's any favorable introductions, people that you know that want this sort of information, that need professional advice, that need oversight from a fiduciary standpoint to qualified professionals and certified financial planners, you can put us in touch with each other. You can do that several ways. You can reach out to your advisor. You can also email our onboarding team at info@planpwg.com. That'll go directly to one of our partners, and we'll make sure that we reach out. So thank you again for that. And we are back in taking on new clients and opened up capacity. And I'll leave you with this. Stay tuned for our next event. We're going to run our next event July 11th. And we're really excited to introduce the rollout of our new speaker series, which is going to be in a podcast format. It's going to be called Financially Speaking. It's going to be the voice of private wealth, where we're going to share not just investment ideas, but concepts, moments that matter in our lives, right? Someone told me once, it's not about the money, it's about the moments. And so what does that mean, whether it be the birth of a child, a marriage, a separation, or good, the bad, or indifferent? How, what are some things that we should all be aware of to sort of minimize that? Man, I wish I would have known. So we look forward to getting your content, your feedback. We're going to take that back to our team. And then we also look forward to our next time together. So mark your calendars. It'll be July 11th. And we look forward to re-engaging with you then. Lastly, thank you so much for your time today. It was a true privilege and an honor to spend a few minutes in the afternoon together. Thank you to Bryce, Ryan, Bradley, and the First Trust team. You guys are great portfolio managers and great partners. We appreciate your knowledge and your expertise. And to all the ladies and gentlemen on this call that made this happen, Jamie, Solis, thank you for your help in facilitating this. And then the advisors on the call, I'm sure you've seen yours somewhere in the panelist section. But thank you again, everybody. I hope everyone has a wonderful evening, and we look forward to re-engaging and revisiting you in July.